Hello and welcome to this special edition of Newsmaker. I'm Lata Venkatesh. The news. In a bid to increase transparency in the market regulator SEBI has written a consultation paper wanting more disclosures from what it calls high-risk foreign portfolio investors. In this consultation paper, SEBI has proposed that FPIs with more than 50% stake in a single stock or group conglomerate will need to reveal all ownership details. These details have to be given within 6 months, or there is a chance of the FPI itself losing its registration. The move comes after SEBI told the Supreme Court appointed panel that it had, let me quote the SEBI again, drawn a blank or hit a wall in terms of identifying beneficial owners of some of the FPIs invested in the Adani group of stocks. This is with respect to the allegations made by the Hindenburg report. Now, we're discussing the SEBI consultation paper and whether it will be successful in getting all those granular details it wants, whether it will be successful in identifying whether some FPIs may be in cohorts with the promoters. Will it be able to succeed in all this? Joining me to discuss these questions are Deepak Shenoy, founder of Capitalmind, R.S. Loona, former SEBI ED and managing partner at Alliance Law, Vivek Mimani, the partner at Khaitan and Company, and Manendra Singh, partner at Economic Laws Practice. Gentlemen, thank you very much indeed for joining me. Let me start with you, Mr. Loona. Is SEBI in the right direction? This is where it ought to go if it is hitting a wall under PMLA and other rules to find the ultimate beneficiary owners.
Well, identification of beneficial owners of FPI investment has always been a concern of SEBI. And in the existing regulation, there are provisions for making the disclosures in respect to the beneficial owners. The present move is in the right direction because it is identifying the particularly high risk FPIs, which probably according to SEBI or the market insiders, they might have violated the minimum public shareholding norms or the press note number 3 of the government, whereby the investors from the border states of India, they could invest only through the government route. And there is apprehension that some of the investors in the FPIs which are investing here could be from that kind of countries.
Yeah, no, broadly, I get your broad drift. So you say the effort is in the right direction, no questioning that. Deepak Shenoy, just let me get the market point of view. SEBI has filtered out the sovereign wealth funds, the central banks, the government pension funds, widely held or widely invested in public funds. Do you think they have clearly minimized the risk to the market? Only 6% of FPIs. What's your reaction?
I think yes. I think Lata, the large, the fear was, would this apply to say an index fund that has India exposure or partial India exposure? They've eliminated all of those possibilities. They've even given time of 6 months after whenever this becomes a public thing that the numbers can be tweaked and brought down or adjusted. But I think here there is this risk that the 6% also could result in a fall in certain companies or because what they have to do is change their existing contracts with their customers, their investors, to allow SEBI to circumvent any privacy laws that allow them protection under their own home jurisdiction. So that is one thing that could be concerning to even a legitimate fund that by chance or for whatever reason holds these norms. Of course, I think I don't think it's going to be a huge impact, but only the market will tell us which companies are impacted.
Okay. Well, the fact that the market didn't react violently yesterday or today to the announcement seems to give the impression that this is not a disruptive announcement at least. But is there a verdict that it is not an effective announcement, that really this can be circumvented? Is that what we should take from the very calm reaction of the market? Well, that question to you, Vivek. Can you really get to the final beneficial owner from the rules that SEBI has said? Or is it always possible that you put a dummy as the final beneficial owner, but have a private agreement with him or her or it? You think this is a wild goose chase?
See, I think from a practical perspective, it is going to be seen how SEBI is going to implement this. So practically, it comes down to the implementation and whether it's a wild goose chase. From a market perspective, while we are saying it's 6% and going down the personal individuals, a lot also depends on the personal data and what investors are comfortable with. So the question comes, are we chasing investors from India? Because while you have a 50% threshold of a company, investments into a company, there's also a fact that if any FPI, which is in excess of 25,000 crores, that is also categorized as a high-risk category, and there is certain, you go down to the UBO, ultimate UBO. So practically, I mean, it's all going down from an implementation perspective. We have to see that. And when it comes to personal data, people are not comfortable sharing personal data. I mean, with the larger funds, some of them may, assuming they are not public funds, but to that extent, there is a risk which is there. And coming down to private arrangements, the question is that if somebody wants, practically under law, you cannot have private arrangements, but if somebody wants to violate, I mean, it will be a wild goose hunt for SEBI then.
Okay, so there is a little bit of loophole over there. But 25,000 crore, I would assume that there are not so many FPIs in that category. SEBI has not given subcategories. They are saying everybody who come in for high risk amount to only 2.6 lakh crore. Of this, the 25,000 crore must be a very small number, isn't it?
See, that data is not mentioned in the, it's not mentioned in the paper. So some discussion around that, if SEBI had mentioned, maybe we could add objectively to it.
All right, that would be perhaps the next question, if there is a SEBI press conference or any other way. But Manendra, see, Vivek is raising a doubt whether it could be disruptive, whether FPIs would be wary of giving their details. Hasn't SEBI made it a little above board? They're only looking for people who have, I mean, as they say in their observation, more than 50% of their AUM only in one group, and the position has remained static for a reasonable number of years, which gives rise to the hunch that maybe the promoters and the funds are either the same people or in cohorts at least. They're persons acting in concert. Isn't the case built up reasonably well?
So I think how I look at this is the way the consultation paper is drafted and the rationale which have been given by SEBI is twofold. They're trying to capture the whole MPS norms breach. And second, if there's a PN3 violation that can possibly happen. And to understand that, I think it may be said that in the beginning, they are trying to only look at the high level, high risk FPIs. And it's going to be a very narrow list, which the SEBI is trying to figure out. And to answer your question, whether they've gone overboard or not, I think the intent is coming from those two reasons, that PN3 violation and MPS norms. I think it's a direction in the right step, because they want to make sure that, especially in the listed entities space, the decision making is lying with the real shareholders who are going to be controlling the affairs of the company. And somebody maybe probably sitting out of India is not calling the shots in consonance with the promoters or the family groups of the promoters. And that's where they are clearly saying that if that is the situation, then it is not the true float which is being represented in a listed company, and which
exactly the free float. I mean, I think that is the big point that SEBI seems to be making, that we don't want that the free float in effect is 4, 5, 6, 7%. that, some 15-20%, which is actually held by FPIs, is perhaps in some way a proxy for the promoters. That seems to be the underlying message. Mr. Loona, what is your sense? Should the rules have been tighter? I mean, that is one way of looking at it. You have 6 months to bring down the stake. Now, if there is a fund which really wants to circumvent the rules, they can always create another new fund. New funds are given 6 months. So you could just pass on whatever is excess in your investment in one target company. Say, you have 70% of your money in one company. You take out 21%, put it in a new fund. And the new fund has the liberty to be exempt from the rules for 6 months. And then after 6 months, you create another. So do you think this 6 months is too loose?
I think let us understand that what is 6 months they're talking about. They're saying that the disclosure requirements, which are additional requirements, they are required to be complied with by these high risk FPIs after 6 months. The reason being that during this period, if they bring down the investments below the threshold limits of 50% in a company or group of companies or 25,000 crore overall investment, then in that case, they will not be required to comply with the additional disclosure requirements. In fact, it raises a doubt in my mind whether the intention or the purpose of the circular is going to be served by giving this kind of long ropeway to the FPIs to comply with this.
So you do think it's a long rope that they've given, too long?
I mean that with this you can probably take care of the future violations, but if the intention of the circular is to catch hold of the people who are already committing or who have committed this violation of the minimum public shareholding requirement or press note number 3, then I think the period should be maximum 2 months or so, because otherwise within 6 months nobody will be available. Everybody will go scot-free.
Yes, sir.
And we should ensure that they are given. And I understand that we can't have the abrupt
change in law
of this investments in the market, because that can also impact the script's valuation and can cause losses to the FPIs, which is not as per the government's policy of doing use of business and all that.
Now, Mr. Loona,
should be a reasonable one.
So you make a very important point that 2 months perhaps would be enough. And I want to put that to the vote of the rest of the panel in a minute after the break. Please think over that question.